Welcome back to the deep dive. This is where we dig into the details, the source material, and pull out the insights that matter, tailored just for you. Today, we're tackling two absolute giants of retail, maybe the giants, Walmart and Costco.
That's right. Our mission here is to really go beyond the surface news and get into their latest official filings. We've got Walmart's big annual 10K report. That's for their fiscal year ending January 31st, 2025. And then we have Costco's latest quarterly 10Q, which covers up to May 11th, 2025.
Yeah, and that's a key difference to keep in mind, isn't it? A full year view for Walmart versus a more recent snapshot for Costco. But we're not just looking at the big sales numbers. We want to understand, how they're growing, how they're managing efficiency, and honestly, how they're dealing with the kind of risks that only come with being this massive.
Exactly. At this level, just managing the sheer complexity, that itself becomes a major factor, even financially. So let's maybe start with the revenue picture.
Okay. Segment 1, membership and omni-channel. When you look at Walmart, the scale is just hard to comprehend. What's driving their revenue strategy according to that 2025 report?
It's sheer volume, but it's also how they slice it up globally. Their total consolidated revenues, get this, $681 billion for fiscal 2025.
Wow.
Yeah. And what's really telling is the breakdown. It shows where their strategic focus lies.
So how does that massive number break down then?
Well, Walmart US is still the powerhouse. Pulled in $462.4 billion. That's, about 69% of the total sales?
Still the giant within the giant.
Absolutely. But the other parts are huge, too. Walmart International, that's $121.9 billion. And then Sam's Club US, their warehouse competitor to Costco, brought in $90.2 billion.
And Sam's Club brings us straight to membership, which feels increasingly central, not just there, but, with things like Walmart Plus, too.
Oh, completely. That membership income stream, it's almost pure profit, high-margin stuff. And it's critical. For fiscal 2025, Walmart's total membership and other income jumped up to $6.4 billion. That gives them serious operating leverage. It lets them keep prices sharp on the retail side.
Okay, so let's pivot to the company that basically built its entire model on that fee, Costco. We're looking at their Q3 2025 results. Net sales, nearly $62 billion.
Yeah, almost $62 billion. That's an 8% increase compared to the year before. And they helped fuel that by opening 29 net new warehouses over that period.
But for Costco, it's less about massive segments and more about the member itself, right?
Exactly. It's all about the member relationship quality. Their membership fees just for that quarter were $1.24 billion. That's up 10%. And the base is enormous and incredibly loyal. We're talking 79.6 million paid members. That supports 142.8 million total cardholders around the world.
And that loyalty shows up in the renewal rate, which is always just, eye-popping.
It really is. Almost unbelievable. U.S. and Canada holding steady at 92.7% renewal. Worldwide, 90.2%.
Still incredibly high.
Hugely high. Although they did mention a tiny dip, a little ripple.
Oh!
Yeah, in the filing, they noted a small negative impact. Apparently, members who signed up during a specific digital promotion back in fall 2023 were hitting their renewal period this quarter, and that slightly dragged the overall rate down.
Huh. Shows how even small past decisions echo at this scale.
It really does. Every little bit counts.
Okay, let's talk digital. The omni-channel race. Blending bricks and clicks. Who's getting traction there?
Well, they're both making moves, but maybe in slightly different ways. For Walmart US, e-commerce added about 2.9% to their comparable sales growth in FY 2025, and the key there is how. It was mainly driven by store-fulfilled pickup and delivery.
So using their existing stores as mini fulfillment centers, basically.
Yeah, exactly. Leveraging that massive physical network. Sam's Club saw something similar, a 2.3% positive bump from e-commerce, again, mostly from club-fulfilled curbside pickup.
Makes sense. Optimize the assets you have.
Precisely. And you see investment there, too. Sam's Club rolled out Just Go in FY 2025. It's like a friction-free exit, complement scan and go and curbside. It's all about making that blended experience seamless.
Okay, contrast that with Costco. Their e-commerce numbers looked pretty strong on their own.
Yeah, Costco's pure e-commerce comparable sales jumped 15% in Q3 2025. So a different kind of growth there, maybe less reliant on the store fulfillment piece, more on direct online sales.
Interesting dynamics, but despite all this growth, both giants mentioned something that seems counterintuitive, hurting their sales figures, lower gas prices.
Yeah, it's funny, right? Good for us drivers, but it actually messes with their top-line revenue comparison.
Yeah.
Costco specifically called it out. Lower gas prices negatively impacted their net sales by $642 million in Q3. That's 112 basis points.
So 1.12% shaved off the top line just because of gas prices.
Exactly. Even though, and this is the kicker, the actual volume of gasoline they sold ticked up slightly, about 1%. It just shows how volatile commodity prices can distort the big picture.
Yeah, definitely something to keep in mind when just looking at headline revenue growth. Okay, let's shift gears. Segment 2, financial health, margins, capital. For Walmart, it feels like a constant balancing act. Keep prices low, but also boost profitability. How did they manage that on the margin front in FY 2025?
They actually managed it quite well. According to the 10K, Walmart's overall gross profit rate, it increased by 40 basis points, so 0.40%, hitting 24.1%. And critically, this wasn't really about hiking sharp prices. It was more strategic. Walmart US did a better job aligning its prices against competitors, hitting those historic gaps. And maybe more importantly, they really scaled up their higher margin side businesses. We're talking digital advertising and their third-party marketplace.
So the ecosystem play. Use those higher margin services to kind of subsidize the core low-price retail model.
That's a big part of it, yeah. But on the other side of the ledger, their operating expenses did tick up a bit.
Okay, what drove that?
Expenses rose by 36 basis points as a percentage of sales. Three main things. Higher variable pay, basically bonuses, because they beat their performance targets.
Good problem to have, I guess.
Right. Also, more spending on marketing and significantly higher depreciation costs.
Which suggests new investments coming online.
Exactly. All those capital projects started to hit the books.
Okay, now Costco. Their margin story seems maybe simpler, more focused on the actual stuff they sell.
That's a fair way to put it. Costco saw its gross margin percentage improve across the board. US, Canada, other international. And the drivers were pretty straightforward. Better performance of their core merchandise. Think fresh foods, regular foods, sundries. Just a solid operational execution on the things people come there to buy.
Operational discipline paying off. Okay, let's talk capital metrics. Walmart's return on investment, their non-GAAP ROI, nudged up slightly to 15.5% in FY 2025 from 15.0%. Healthy sign.
Yeah, that ROI improvement is definitely positive. It indicates better overall business performance. But the cash flow story has an interesting wrinkle. Their net cash from operating activities that actually went up hit $36.4 billion in fiscal 2025.
Okay, operations generating more cash. Sounds good.
It is, but, and here's the twist, their free cash flow, that's the cash left after capital spending, actually decreased, dropped quite a bit, down to $12.7 billion from $15.1 billion the year before.
Wait, operating cash up, free cash down. How does that work? What does that signal?
It signals deliberate, heavy investment. The reason free cash flow went down wasn't because operations faltered. It was because capital expenditures, CapEx, jumped by a massive $3.2 billion.
So they're choosing to plow that cash back into the business aggressively.
Exactly. They're prioritizing strategic investments, think logistics, tech, digital platforms, over just letting that cash sit there and return it immediately. It's a big bet on future infrastructure.
Got it. And speaking of cash, on the Costco side, you can't ignore that membership fee advantage, the float.
Oh, the float is legendary. It's basically an interest-free loan from millions of members. As of May 11, 2025, Costco's deferred membership fees, that's money collected but not yet recognized as revenue, sitting as a liability, was a staggering $2.931 billion.
Almost $3 billion just sitting there, upfront cash.
Yep. Incredible liquidity generated before they even sell a single Kirkland signature product. It's a huge operational advantage.
No kidding. Okay, that covers the money side. Now for maybe the less glamorous but equally critical part. Segment 3, litigation and risk. This is where reading these filings gets really eye-opening about the sheer complexity these companies manage.
It really is. The sheer volume and the variety of legal challenges is just...
I don't know.
It's a masterclass in global regulatory environments. Let's take Walmart. The opioid crisis shadow is still long. Even after they set aside and paid out about $3.3 billion for settlements back in fiscal 2023, it's not over.
Still active litigation.
Yeah. There's still a big Department of Justice civil suit moving forward related to how they distributed and dispensed medications. The trial for that isn't even scheduled until November 2027. Separately, though, a related shareholder lawsuit was actually settled last December 2024, and that resulted in about $99 million being awarded back to Walmart.
Interesting twist. Okay, beyond opioids, what else? Labor seems like a hot spot, especially with the delivery networks.
That's a big one. They're fighting lawsuits over how they classify their drivers, independent contractors versus employees. That's a huge issue across the gig economy, right? And on top of that, the CFPB, the Consumer Financial Protection Bureau, sued them in December 2024. That's about requiring drivers to be paid through a specific financial product.
So regulatory heat on their logistics model, and these risks aren't just in the U.S., are they?
Not at all. Their international scale brings international headaches. Walmex, the Mexican subsidiary, got hit with a fine, about $5 million US, from COFES, Mexico's antitrust regulator.
What was the allegation there?
Alleged monopolistic practices with suppliers. Walmex is appealing it, but still. Yeah. And then in India, their Flipkart business faces ongoing investigations related to foreign direct investment rules and antitrust concerns. The legal risks are truly global.
Okay, so that's Walmart. Costco's legal challenges seem maybe different, more consumer-facing, perhaps?
Yeah, a different flavor of risk, definitely. Very consumer-centric. Privacy is a big one for them right now. Costco is fighting 5 separate class action lawsuits. They all allege privacy violations because of pixel trackers used on Costco.com. Cites various laws in Washington and California.
And how's that progressing?
Well, the court denied Costco's attempt to dismiss the main consolidated complaint back in November 2024. So those cases are moving forward. That's a significant potential headache in the digital privacy space.
Definitely. And then there was that item, the one that kind of jumped out at me from the filing, the baby wipes lawsuit.
Ah, yes. That's a perfect example of just how intense the scrutiny is, especially on store brands like Kirkland Signature. There's a lawsuit alleging their Kirkland Signature fragrance-free baby wipes contain PFAS, about 3.7 parts per billion.
PFAS, those are the forever chemicals, right? The ones that don't break down.
Exactly. And polyfluoroalkyl substances. And the issue in the lawsuit isn't just that they're present, it's that the wipes were marketed as being, quote, made with naturally derived ingredients.
Ah, so the claim is that the PFAS presence contradicts the marketing.
Precisely. And again, the court seemed to be taking it seriously. Costco's motion to dismiss the amended complaint was denied just this past May 2025. Ingredient transparency is clearly a battleground. Oh, and they also settled a smaller matter with the EPA about misbranded devices sold as pesticides under FIFRA, but that was for an immaterial amount.
Okay, so specific product and privacy issues for Costco. Zooming out, though, is there a universal risk that hits both of them hard?
Oh, absolutely. The big one that cuts across both, and really any massive modern enterprise, is cybersecurity and supply chain vulnerability. Both filings really hammer this point. Walmart, in particular, calls out cyber threats as rapidly evolving.
Right.
You mentioned sophisticated criminal groups, even nation-state actors targeting their systems.
And as they invest more in tech and e-commerce?
The complexity grows, the attack surface expands, they're pouring billions into these networks, and a huge chunk of that spending is just defensive. It's an ongoing, expensive battle just to protect what they've built.
Right, a constant arms race. Okay, let's try to wrap this up. Outro time. So, pulling it all together, what's the headline here? We've got these 2 retail behemoths, both driving serious growth, largely through getting more people shopping more often and making that online-offline experience work. Walmart seems defined by its incredible scale, managing these huge global segments and using services like advertising to help the bottom line.
Yeah, mastering complexity at scale. Whereas Costco feels more laser-focused. Their win comes from that unbelievable membership loyalty and just being incredibly good at selling the core stuff in their warehouses, improving those margins bit by bit.
Focus versus breadth, maybe?
Something like that.
Yeah.
But digging into those legal sections, wow, it really highlights the intense, constant pressure they're under from regulators and lawsuits everywhere. We're talking multi-billion-dollar opioid settlements, fights over driver classification, digital privacy class actions, even scrutiny down to the chemical traces in baby wipes. The sheer amount and type of litigation is just part of the cost of doing business at this level. It's baked in.
It definitely makes you think about where the real competitive advantage lies now. Is it just price, or is it something else?
Well, that leads to a final thought, maybe something for you, our listener, to consider. Walmart reported $1.8 billion in depreciation and amortization just for its corporate segment in fiscal 2025. Right. Think about that number. It represents massive investment in technology, automation, logistics infrastructure, all the stuff shoppers don't really see directly. So the question is, how much of the future success for giants like Walmart and Costco will actually depend on winning the invisible high-tech infrastructure race rather than just the price war we see on the shelves?
That is definitely something to chew on. Where is the real value being created? Thanks for digging deep with us today. That's all for this edition of The Deep Dive.